The ordinary person looks at economics and sees a blur of numbers: inflation rates, stock prices, unemployment figures, the cost of groceries, the interest rate on their mortgage. It feels like a weather system, a force of nature that is either fair or foul, something that happens to them, something they must endure. But to the financier, the investor, the builder of empires, economics is not a force of nature. It is a machine. It is a system of interlocking gears, and while most people spend their lives staring at the dials and gauges, the few who understand the machine know exactly where to place the lever to change the direction of the world. This lesson is the blueprint to that machine, and once you see it, you cannot unsee it. At the heart of every economy is a single, solitary engine. That engine is human labor, transformed into productivity. The total output of an entire nation, what economists call gross domestic product, is nothing more than the sum total of all the productive work done by its people, multiplied by the tools and systems they have at their disposal. An economy does not grow because money is printed. It grows because a worker with a shovel digs a ditch faster than a worker with a spoon. It grows because a farmer with a tractor harvests 100 times more than a farmer with a hoe. The man who believes wealth is created by the government printing more cash fundamentally misunderstands reality. The printing press can only change the denomination of the wealth that already exists. It cannot create a single bushel of wheat or a single working engine. The true source of all economic growth is productivity, and productivity is the child of investment. This is the first great divide between the common understanding and the institutional one. The average person thinks of investment as a way to save for retirement, a means to accumulate a nest egg. The powerful think of investment as the acquisition of the tools of production. When you buy a share of a company, you are not buying a lottery ticket. You are buying a piece of an engine that converts human labor and raw materials into something the world wants. The true owner of an economy is not the person with the highest salary, but the person who owns the most productive assets. The worker trades their time for a wage. The owner trades their capital for a perpetual claim on the output of the workers and the machines. That is the fundamental distinction. One party is paid for their effort, which ceases the moment they stop working. The other party is paid for their ownership, which continues to generate income whether they are asleep, on vacation, or dead. This is where the second, more insidious mechanism of the machine emerges: debt and its relation to cash flow. The personal finance industry has spent decades demonizing debt, teaching the average person to fear it, to consolidate it, to eliminate it as quickly as possible. This is sound advice for an individual whose income comes solely from their labor, because their cash flow is fragile and finite. But in the world of finance and control, debt is not a burden, it is a tool. A corporation does not view a loan as a liability in the way a person views a mortgage. A corporation views debt as a way to acquire assets that generate more cash flow than the cost of the debt itself. This is leverage. If a billionaire can borrow at 4% to buy a building that generates an 8% return, they are not losing money. They are creating a mechanism that prints wealth from the spread. The wealthy do not fear debt. They fear illiquidity, which is the inability to access cash when an opportunity presents itself. Consider the difference between income and cash flow, a distinction that is the cornerstone of dynastic wealth. Income is what you earn from your labor, a salary or a wage. It is taxed heavily because it is the most visible and easily traceable form of wealth. Cash flow is the money that flows into your pocket from assets you own: rent from a building, dividends from a stock, interest from a bond, profits from a business you control. The truly wealthy structure their lives not to maximize their income, which is taxable, but to maximize their asset ownership, which generates cash flow that can be protected, deferred, and passed on. A celebrity may earn $20 million a year from acting, but after taxes, living expenses, and the cost of maintaining their lifestyle, they may be left with very little. An investor who buys a portfolio of commercial real estate might show a modest income on their tax return, offset by depreciation, interest, and maintenance costs, while in reality, their net worth grows by tens of millions of dollars annually through appreciation and the steady accumulation of rent. The power of this machine is amplified by the institutional players, the great banks, the hedge funds, the private equity firms who act as the engineers of the system. They do not just buy assets, they buy companies, restructure them, and realign their incentives. A private equity firm does not purchase a struggling manufacturing company out of charity or even out of a long-term desire to build a better mousetrap. They acquire it using a significant amount of borrowed money, placing the debt on the company's balance sheet. This forces the management to become hyper-focused on generating cash flow, often through cost-cutting, divesting underperforming divisions, and focusing on core profitability. The goal is to restructure the engine, make it run leaner and hotter, and then sell it for a multiple of the original purchase price. This is not just investing, it is active engineering of the corporate structure to force a return. The public often sees this as ruthless cost-cutting, and it can be, but to the financier, it is simply the logical application of financial engineering to unlock trapped value. The tax code, which most people view as an arcane and confusing set of rules, is actually the architecture of the system. It defines what is incentivized and what is penalized. The law rewards long-term capital gains over short-term speculation, and it rewards investment in real estate and equipment through depreciation, a provision that allows owners to deduct the cost of an asset over its useful life, thereby reducing their taxable income, while the asset may actually be appreciating in value. It is not a conspiracy. It is a reflection of the political power of asset owners. Over the decades, the owners of capital have lobbied for rules that protect and enhance the value of capital, while the rules governing labor have remained relatively static. Consequently, the system creates a powerful gravitational pull toward ownership. If you own the assets, the tax code works with you. If you only own your labor, the tax code works against you. Access to this world is not guaranteed by intelligence alone. It is guarded by relationships and capital. The greatest entrepreneurs are not merely innovators in product design. They are innovators in capital structure. When a founder gives up equity in their company to venture capitalists, they are not just selling a piece of the business. They are buying access to a network, a system of mentorship, and a war chest that allows them to scale faster than their competitors. The venture capitalist is not betting on the product so much as they are betting on the founder's ability to navigate the maze of hiring, sales, and scaling. They provide the fuel, but more importantly, they provide the roadmap. This is why the most powerful institutions in the world are not necessarily the ones with the best products, but the ones with the best access to capital. A brilliant idea is worthless without the financial and institutional machinery to bring it to market. The market itself, whether for stocks or bonds, is not a voting machine for the quality of a company, but a weighing machine for the discounted value of its future cash flows. The stock price is a reflection of the market's collective agreement on the present value of all the money the company is expected to generate in the future, adjusted for the risk that it might not generate that money. This introduces the factor of psychology, the fear and greed that drives bubbles and crashes. When the market is euphoric, investors discount the future at a very low rate, meaning they are willing to pay a high price today for a promise of money tomorrow. When the market is terrified, the discount rate skyrockets, and future cash flows are heavily penalized, leading to a collapse in prices. But this is not a mystery to the institutional player. They understand that market sentiment is a behavioral phenomenon that can be exploited by those who maintain their discipline and their liquidity. The crash is not a time to panic. It is a time to deploy capital into assets that have been irrationally discounted. To survive and thrive in this system, to move from the world of trading time for money to the world of owning machines that generate money, you must reconfigure your understanding of risk. The conventional wisdom is that risk is the chance of losing money. The institutional wisdom is that risk is the chance of being illiquid when an asset is cheap. It is the risk of being forced to sell because you have over-leveraged or because your personal expenses exceed your cash flow. The wealthy do not ask, will this go up in value? They ask, can I hold this long enough to be right? They build buffers, they maintain lines of credit they do not use, and they structure their lives so their personal cash flow can weather years of market stagnation. The tragedy of the average investor is not that they buy the wrong stock. It is that they buy a stock that is temporarily down and are forced to sell it because they need the money. This is the mechanism of wealth transfer. The wealthy buy the assets the desperate are forced to sell. The ultimate lesson of economics, the one that illuminates the entire machine, is that money is merely a claim on the output of the economy. It is a coupon that can be redeemed for goods and services. The man who accumulates millions in the bank has accumulated millions of coupons, but those coupons are only valuable if the economy continues to produce. The true investor, the owner of the assets, does not hoard coupons. They exchange their coupons for the means of production. They buy the factory, the land, the intellectual property, the distribution network. They convert the claim into the thing that generates the claim. They transform their wealth from a passive store of value into an active, growing engine. This is the difference between saving and investing. Saving is preserving purchasing power. Investing is acquiring the means to increase purchasing power. The family office, the private institution that manages the affairs of the ultra-wealthy, is the ultimate expression of this philosophy. It is not a money manager. It is a survival mechanism for an economic organism. It plans for generations, not for quarters. It diversifies not just across stocks and bonds, but across asset classes, jurisdictions, and legal structures. It uses trust to protect assets from litigation and taxes, ensuring that the engine continues to run regardless of who is in charge of the government. It establishes governance rules so that subsequent generations do not squander the machine. The financial dynasties that have survived for 100 years or more did so because they understood that wealth is not a static pile of gold, but a dynamic system that requires constant management, protection, and strategic reinvestment. What the economic machine reveals is that power does not come from the size of one's salary, but from the scale of one's ownership. The salary is a transaction between an employer and an employee, a temporary agreement that ends when the employee stops working. Ownership is a property right, a legal claim that endures and compounds. It is the right to the residual, the leftover profit after everyone else has been paid. This is the secret that the world of high finance operates on, the lever that moves the world. The wealthy do not work for money. They force money to work for them by owning the engines of production that the rest of the world must interact with to survive. The choice for the viewer is not about what to buy, but about what to become. Are you a passive observer of the economic weather, or are you the one who studies the barometer, understands the pressure systems, and positions themselves to benefit from the coming storm?